let's start with kind of a big picture view, JC. A few months ago, you were looking at Canada versus the TSX versus the S&P 500. You were coming down in favor of the TSX. How does that stand now?
Yeah, it's really just a ratio. Essentially, where would you rather be? You want to be in Canada or do you want to be in the United States? And, that ratio, it really tells us an interesting story, because while commodities have gotten absolutely destroyed since the peak in 2011, economies with that sort of commodity exposure, Canada obviously being one of them, have really underperformed. And not just Canada, you can see it in, emerging markets and things of that nature as well. But more recently, we started to see that shift. And over the last 4 or 5 months, Canada has been the outperformer, really leading the way over the United States. So I think at this point, Francis, we could use this ratio for 2 reasons. First of all, for informational purposes. If Canada continues to outperform the United States, I think that's definitely a positive for the commodities market. And then purely from a trading perspective, you read the stuff, there's people out there that are essentially shorting the United States and buying Canada and taking advantage of that ratio. And I think the lows from, the last week, the last 5 to 7 days, those lows bounced off from key former resistance levels. So if the lows from the last couple of weeks hold in there, I think this trend is here to stay. So I think we're up for a big test.
So when we look, so that's one relationship between the 500 and the TSX. But we have a graph just looking at the S&P 500 alone. And give us your thoughts on what to do with this market. We're still in the range, kind of really haven't moved out of that range. But you've got a line that says it might be tough to break out here.
Yeah, I mean, as you know, Francis, we've been awfully bullish, global equity since late January, started getting bullish some of the more developed nations, about February 10th, February 12th, particularly the United States. And we've had a heck of a run. We've wanted to be buying any and all dips in U.S. stocks and global equities, but our targets have been hit, Francis. So, once the data changes, you have to really reevaluate what you want to do. And where we sit right now today, we want to be fading this strength. And, we started turning neutral over the last couple of weeks. And then, what we've been seeing from the intermarket complex really suggests that, getting short or really looking to initiate short positions is probably the best risk reward here. So with the S&P 500 specifically, we are running into that downtrend from the highs late last year. Again, our targets have been hit. The intermarket relationship suggests fading this strength. And if we're below 2056, that's my line in the sand. If we're below 2056, we want to be shorting the S&P 500.
JC, I always like to provide a little education to our viewers. And you wrote something interesting last week. We'll get into some of your specifics. But you said, you were selling some stuff, individual names that you had caught at the low. And you said something to the effect of, they don't know us anymore. Once I'm gone, I'm gone. People have a tendency to kind of wring their hands after they sell something and say, oh my God, I sold it and it's up $1. You just leave it alone and move on.
That's absolutely right. And that's a human flaw. It's all of us, myself included. That's just how we're built emotionally. And, the first step to recovery is acknowledging that you have a problem, right? And us as humans, the way we're built, we have that problem and we get very emotional with our stocks. So I've really made it a point over the years, learning through mistakes, of course, that once the stock hits your target and you're out, now it just becomes another stock like anything else. It just gets back into the universe. We don't treat it any differently. If we sell the stock and it keeps going, oh, wow, who cares? It's not our problem. If it crashes after that, terrific. Again, not our problem. So really, that's how we want to reevaluate. In the case of the S&P 500, we loved it over the last couple of months. Our targets were hit. We became neutral. But now, after we've gotten more data, I think that we're best on the short side. So what we want to look at now, right now where we sit today, I absolutely want to be short. I think that if we can get some consolidation over the next few weeks throughout April, kind of digest the recent gains without correcting through price, then I'll have to reevaluate that stance, maybe get back to neutral, and maybe even get bearish. But based on the weight of the evidence that we have in front of us today, Francis, I want to be short.
Interesting. You also have a pretty interesting neutral trade. Now, everybody thinks about doing one or the other, but we're going to show the technology ETF versus the financials. Technology been doing okay, financials not so much.
Right, and technology has not just been doing okay, technology has been doing great. It's definitely one of the strongest sector, particularly from a relative basis. So we don't necessarily want to be shorting technology, even if we don't like the market. Now, on the other hand, financials look like garbage. I mean, there's no way around it. Particularly the European banks, Francis, they look atrocious. So, when I talk about the weight of the evidence and getting short, when financials are underperforming and they look this bad, it's very difficult for the market overall to go higher. So if you don't want to be short, and which is fine, and you prefer to have a more neutral stance, I think you can buy technology and short financials. So for every dollar we're long the XLK, we're long the technology sector, we are short $1 of the financial sector, which includes all of the banks, XLF. So that ratio is actually breaking out as we speak from a consolidation from, where? March 2009 of all time. So as we break out, I think we have at least another 10% higher in this particular ratio with a very well-defined risk reward. I like it. I like financial short, and on the long side, I prefer to be in technology over any of the other sectors for sure.
And if you want to cherry pick technology, I understand, again, these relationship charts, you like Twitter over Facebook, and that's starting now. I mean, it's been better to be in Facebook than in Twitter up until pretty recently.
Yeah, I do. And again, getting back to the risk versus reward, Twitter's a stock that we've kind of liked over the last couple of months. Hasn't really participated as well as I would have liked, but it's still hanging in there. It's still above key support levels, so there's no reason to not be in it. And then as far as Facebook is concerned, I don't want to short Facebook outright. This is a pair where we can be long Twitter, short Facebook. And as long as we are above those February lows in that ratio, I think we could be long the spread. And while we might have a couple of percentage points of risk, I think that we have 50% of upside. So I think the reward potential more than justifies the amount of risk, for sure.
Now, just finally, is your risk defined in the grain space? I know you've been talking about corn, and I don't understand the mash versus the beans versus the oil and soya, but you've been looking at all that. Is there an opportunity in the grains going into the summer?
I think there's been an opportunity. Things like cotton have really exploded. We've done very well in that particular space. And I think on a relative basis, you're starting to see some changes. Remember, these agricultural commodities have just gotten destroyed over the last several years. Early last year, we did get a little bit of a bounce. That rolled over. But I think this could be for real. If you look at DBA, which is an agricultural fund, we are breaking out of a multi-year downtrend line. And as long as we're above that, we can be long. So again, another scenario where the risk is very well defined. Remember, Francis, it's not about being right. It's about making money, right? That's why we're here. I'm not an analyst where if I'm wrong, it's called a revision. We're money managers. So if you're wrong, it's called a loss, right? But if you keep your losses small and you let your profits run and the risk versus reward is consistently skewed in your favor, whether long or short, again, it doesn't matter. It's not about being right or wrong. It's about making money and keeping that money. So from a risk-reward standpoint, down here, it's hard not to like the ags, Francis.
You got to weigh those risk-rewards, and defined risk is a good way of looking at it, JC. Always good to hear your thoughts, especially on a Monday morning. Thanks for joining us.
Love it, Francis. Thanks for having me.
Talk to you soon. allstarcharts.com.